Hi guys, this is day 14 of the A2 Economics Revision Challenge, and today we're doing demand for money or liquidity preference theory. The demand for money refers to the desire to hold money, that is your wealth, in the form of money rather than you use it to buy goods and services or use it to buy bonds or even keep it in a interest-bearing bank account. When you do so, when you hold money or when you hold your wealth in the form of money, or when you prefer what we say liquidity, and that's why this theory is also called the liquidity preference theory, the preference to hold money or preference to have liquidity, there is a price we pay for it, and that price is the interest that is foregone. So the opportunity cost of holding any money balance is the extra interest that could have been earned if the money had been used instead to purchase bonds or to keep it in an interest-bearing bank account. So therefore, the demand or desire to hold money, it doesn't result in what we call no opportunity cost. There is money that is foregone, and that is the interest that is foregone. And that's why when we look at the demand, we look at it from the perspective that if you hold this money in the form, or if you hold your wealth in the form of money, what is it has to be important enough for us to make sure that it is giving us that return, that is the interest that is foregone. We identified three reasons why people demand money. The first one is what we call the transactionary motive. The second one is what we call the precautionary motive. And the last one is what we call the speculative motive. Transactionary plus precautionary motive is also called together, is also called sometimes active balances. And I'm going to talk about this in a little while. While speculative demand is what we call sometimes idle balances. And both active plus idle balances makes up our liquidity preference or the demand for money. Let's look at transaction demand first. So when we look at transaction demand for money, it's the demand for money where people are using it as a medium of exchange. It is when we are using it to buy day-to-day goods and services, like for example bread, butter, and so on. And this is where everyone requires money, for example, to undertake transactions on a day-to-day level. Now we say transaction demand for money is extremely important because again people need money to undertake transaction, and that is where like rather than keeping your money in the bank, you would want to keep money in your hand because you need to buy goods and services. There are two things that we believe can affect transactional demand for money. One is what we call frequency of payment. So the first thing we want to look at is basically what we call frequency of payment, where if the people are receiving money at frequent intervals, then you will see that they may not require to demand money that much because they know at the end of the day they can get the payment quickly from wherever sources. So for example, if you're paid a monthly salary, you're likely to keep more money as transaction demand than, let's say, if you paid salary on a daily basis. So people receive money at intervals and not continuously, so they need to hold money balances in cash or current accounts. So the more frequent that payment is, for example, the more frequently you required, you are getting your salaries and so on, the more you will, the less you will need to keep money in your pockets, because you know that you would rather not want to go to the bank because every, let's say, weekly or sometimes every daily you may get a salary. So the higher the frequency of payment, the lower we'll see this kind of demand or transaction demand for money. The second thing we look at in terms of transaction demand for money is the fact that transaction demand for money also is directly related to the GDP of a country. The higher the GDP, the more people will have the money to undertake transactions, and therefore the more will be such demand for transactional purposes. So two factors that affect our transaction demand is, one is the frequency of payment, and the second one is the income or GDP people get. The more income people get, the more they will demand goods and services, and the more they will demand the money to buy those goods and services. In a way, we look at money as what we call derived demand, derived from the goods and services that people would want to buy. Now let's look at precautionary demand for money. When we look at precautionary demand for money, this is where we're looking at basically money as a source for any unexpected sort of event or bargain. So firms and households also demand money to meet any unexpected expenses and take advantage of any unforeseen bargains. This is where, for example, let's say for any emergency, you may need to keep some cash, or for example, a flat tire, you may need to have some money in order to make sure you are able to meet this kind of demand. Normally, both transactional and precautionary demand for money would not require large amounts of money to be carried, but we say both of these balances or both of these demand are important, and as a result of this, we say this, that money that is held for both transactional and precautionary demand is basically called the active balances, which are those balances that are very likely to be spent. And that's why when we look at these balances, we say they're very inelastic. And the reason is this, that these are what we call the necessary spending or necessary amount that you have to keep for your day-to-day transactions or for any emergency. And that's exactly why the relationship is what we call not so responsive to any change in interest rates or interest inelastic. So even though the interest rate may significantly change or may change, we will not alter or cut back on these spending too much. If I draw the diagram for active balances, that is transactional plus precautionary demand for money, on my y-axis I'm going to keep interest rates, and on my x-axis I'm going to keep our quantity of money. So this is how it will look like. So this is interest rate on my y-axis, and my quantity of money on my x-axis, and I'm looking at a very interest inelastic curve, something like this. Not a perfectly inelastic curve, but very inelastic curve, or LP1. Now, one thing you need to look at is that when the interest rate goes up from R0 to R1, you can look at that. When the interest rate is going up, you can see the quantity of money to go down, right? But not by that much. That is why it is very interest inelastic, which is not so responsive to a change in interest rate. So transactional plus precautionary demand for money is that demand for money which is necessary spending, where people try to keep cash despite any significant rise in interest rate. There is an opportunity cost, of course, but the reason why you keep that money is so important, that you are willing to sacrifice the interest for these reasons. The second thing, or the third thing in fact, we look at is what we call the speculative demand for money. When we look at speculative demand for money, who are speculators? Speculators are those people who are buying assets when the price is low, but selling assets when the prices are high. So they buy low and they sell high. Now, this demand for money or speculative demand for money are those people who will basically wait for these securities to fall in price. So, if you're a speculator and if you believe that the price of bonds or securities will fall in the near future, you will hold money balances only to wait till the price goes down. Therefore, what we say is this, that firms and households will hold money balances, which are sometimes called idle balances, when they believe that the return from holding these financial assets is very low. So the idea goes this, that if you are somebody who is wanting to buy any financial asset and you feel that the price will go down in the future, you may want to hold these balances, money balances or idle balances, only with the hope that when the price goes down, you will have the money to quickly buy those financial assets. So speculative demand for money is where we are looking at the opportunity cost of holding money very seriously. And we say this, that when the interest rates are high, the opportunity cost of holding money balances is high, because now you want to basically see, like, is it worthwhile to hold money balances or not? What if the interest is really high? Then in that case, you'll be like, you know what, rather than waiting for that property or for that asset to fall in price and then buy it, I just put my money in the banks because the banks are giving me better return, or some other assets are giving me better return. So when the interest rates are high, the opportunity cost of holding money is high and idle balances will be low. Similarly, when the interest rates are low, the opportunity cost of holding money balances is low, and therefore idle balances will be high. So we say that idle balances, first of all, have what we call an inverse relationship with interest rate, which makes sense because, you know, like, there is an opportunity cost, but also the fact that not only that, but they also have a very interest elastic relationship. So if I'm drawing a graph for idle balances or speculative demand, this is how it will look like. It's a very interest elastic relationship. So I'm going to make a very interest elastic demand for money, LP, demand for money, let's call it LP2. And the interest rates, when they are really high, we will be holding sort of less money balances because the opportunity cost is high, let's call it M naught. While when the interest rates are low, we will be holding more money balances, let's say M1. So the idea goes this, that lower the interest rate, higher the money will be holding, because the opportunity cost of holding money is low, but also it's a very interest elastic relationship. Remember, the speculative, the transactionary and precautionary demand for money were interest inelastic, because it was for funding that was the necessary kind of spending. You may need to have that fund, you know, no matter how high the interest rates are. So combine this together, the speculative plus transactionary plus precautionary. So I'm going to show you this. Combine these two graphs, the interest inelastic and interest elastic graphs. Both of these graphs together make up my demand for money, because this is transactionary plus precautionary, and this is speculative, and combined together I get myself what we call my money demand or liquidity preference curve. So let me just look at it together now. So we have a curve like this, where the demand for money will be LP1, which is transactionary plus precautionary, plus speculative, which is LP2, will be my demand for money. And therefore, there is a downward sloping relationship where between demand and money. Now, in our last chapter, we did money supply, and we saw how money supply is basically fixed by the government. So what's the relationship between money supply and money demand? We say money supply in our model is completely fixed by the government or central bank, which is the representative of the government. And this money supply can change, as we saw in the last video, through, for example, bank lending, through reserve ratio, through total currency flow, or open market operations. So let's say if the money supply is fixed by the government at MS sort of naught, let's call it M naught, then in fact let's call it Q naught for ease. And so then where money supply and money demand meets, this is my demand for money. Where money supply and money demand meet, you get yourself equilibrium interest rate. So we say the equilibrium interest rate is basically found where money supply and money demand meet in a market, where money supply is fixed by the government and can change. For example, government can, for example, lower the reserve ratio and increase money supply. Something like this can happen. If money supply goes up, we know this, that the interest rate can fall in the economy. So we can have an interest rate, like for example, like R1. Now, there's one more thing which you need to understand this. Like, let's say you are at point A, right? If the government increases money supply, suddenly at the current interest rate of R0, at the current interest rate of R naught, money supply is here while money demand is here. In other words, money supply exceeds money demand. And when money supply is more than money demand, basically there are a lot more people who are willing to loan, or there is excess liquidity in the market than the demand for it, because demand is still at A while money supply has probably gone to somewhere point B. Like if I extend this point B, so there is an excess supply. Excess supply means price will fall or interest rate will start to fall, and interest rate will start to fall till we come to an equilibrium at point C. So the lesson that we learn in this whole idea is this, that the market forces of demand and supply results in the interest rate to be determined in the market. Where money supply and money demand meet, we get our market interest rate.